Hey everyone, and welcome back to the channel. Today we're diving into the quarterly results of a fan favorite for dividend investors, Realty Income Corporation, ticker O. The company just reported its Q3 2025 earnings, and while the headlines might show a miss, the underlying story is one of strong, confident growth. Let's break down the mixed but ultimately solid results. Realty Income Corporation is a premier real estate investment trust, renowned for its monthly dividend payments, which have earned it the nickname the Monthly Dividend Company. The core of its business involves acquiring and managing a diversified portfolio of commercial, freestanding properties that are primarily triple net leased to high-quality tenants from industries like retail, convenience stores, and service providers. Under this lease structure, tenants are responsible for most property expenses, including taxes, maintenance, and insurance, which provides Realty Income with predictable and growing rental revenue. This reliable cash flow model has allowed the company to build a remarkable track record of increasing its dividend for decades, making it a popular investment for those seeking steady income. First, let's look at the key numbers that everyone watches. Earnings per share. They reported 0.35, which was slightly below the analyst's consensus of 0.36. That's a small miss, and that's why we saw some muted reaction in the stock price. Total revenue. Here's where things get interesting. The company brought in a massive $1.47 billion, soundly beating estimates of $1.36 billion by over 8%. That's a significant top-line beat. Adjusted Funds from Operations, AFFO. This is the most important metric for a REIT. Realty Income reported an AFFO of $1.08 per share, which actually exceeded expectations. AFFO is a better measure of a REIT's cash flow than net income, so this is a very positive sign. So the picture so far is a slight bottom-line miss, but a strong beat on revenue and the key cash flow metric. But the real story is in what the company is doing with all that cash.
Realty Income wasn't shy about putting its capital to work. In just 3 months, they invested a whopping $1.4 billion into new properties. The breakdown is crucial. They deployed $1 billion in Europe at a very attractive initial yield of 8%, and another $380 million in the U.S. at a 7% yield. This aggressive activity prompted them to raise their full-year 2025 investment guidance from $5 billion to approximately $5.5 billion. That's a clear signal from management that they see plenty of high-quality, high-yielding opportunities out there. And the quality of their existing portfolio? Impeccable. Occupancy sits at a stellar 98.7%. And when they do have to release a space, they're actually capturing 103.5% of the previous rent. This shows their properties are in high demand and their asset management is top-notch. Let's talk about the international strategy for a moment, because it's becoming a major pillar of growth. Realty Income's European portfolio is no longer a side project. They now have 572 properties across 8 European countries. This segment generates about $926 million in annualized rent, making up nearly 18% of their total rental income. This geographic diversification is a huge plus. It reduces their reliance on any single economy and gives them access to a broader pool of attractive deals. Furthermore, their tenant base is incredibly well spread out, with no single client representing more than 3.3% of their rent. This massively reduces concentration risk. So, how did the market react? With a bit of a shrug, to be honest. The stock dipped a very slight 0.29% after hours, likely due to that small EPS miss. But for long-term investors, the outlook is what matters. Management slightly narrowed their full-year 2025 AFFO guidance to a range of $4.25 to $4.27 per share, which maintains a steady and confident outlook. With an enterprise value of around $85 billion, Realty Income isn't just a REIT, It's a real estate juggernaut that is executing a clear and successful growth plan. So the bottom line on Realty Income's Q3? Look past the minor EPS headline. The company is demonstrating robust revenue growth, aggressive and smart capital deployment at great yields, and a fortress-like portfolio. The bull case for Realty Income is built on a rock-solid foundation, and recent developments have only strengthened it. First, management is signaling major confidence. They just raised their full-year 2025 investment guidance from $5 billion to $5.5 billion. That's a 10% increase, telling us they see a pipeline of high-quality, accretive deals ready to be made.
Second, the European expansion is a game changer. While the U.S. net lease market is getting crowded, Europe offers a fresh playground. The market is more fragmented, and the yield spreads are attractive. This isn't just a side project, it's a core part of their growth strategy, providing crucial geographic diversification. Third, the fundamentals are still incredibly strong. We're talking about a portfolio occupancy rate of 98.7%. That's elite. Even when tenants leave, they're recapturing rent at 103.5% of what they were getting before. That's a sign of a high-quality property portfolio and effective management. And you can't talk about Realty Income without mentioning its financial fortress. It has an investment-grade credit rating, manageable leverage, and is now the sixth-largest global REIT by enterprise value. This scale gives it a huge advantage in accessing capital and striking deals that smaller players simply can't. Finally, despite all these strengths, many analysts argue the stock remains fairly valued compared to its peers, suggesting there's room for growth if it continues to execute. However, it's not all smooth sailing. The bear case highlights some real cracks in the armor that investors cannot ignore. The most immediate red flag was the Q3 earnings miss. While revenue was strong, they missed on EPS. This shows that rising operational costs, like higher general and administrative expenses and leasing commissions, are starting to bite into profitability. Then there's the issue of tenant quality. The company expects a rent loss of about 75 basis points in 2025, which is higher than their historical average. This is largely tied to tenants they inherited from past mergers, like the Spirit Realty deal. It introduces an element of cash flow uncertainty that we're not used to seeing with Realty Income. Speaking of competition, the U.S. net lease market is getting crowded, especially with private equity firms diving in. More buyers mean higher prices for assets and lower potential yields, which could squeeze their growth margins going forward. And that promising European expansion? It comes with a flip side: economic uncertainty. A slowdown in key European markets could hurt the performance of that new portfolio and create valuation volatility. Finally, the market's reaction to the Q3 report was very telling. The stock price dipped on the EPS miss, showing that investors are cautious and quick to punish any sign of weakness, even when other metrics are solid. Realty Income has achieved dividend aristocrat status by not just paying, but increasing its dividend annually for 28 consecutive years. Think about that. Through multiple recessions, market crashes, and economic cycles, this company has consistently returned more and more cash to its shareholders. And it pays those dividends monthly, which is a huge benefit for investors looking to compound their returns or live off a steady income stream. The key to this reliability? A very sustainable dividend payout ratio, typically sitting in the 70 to 80% range. This means the company earns enough to comfortably cover its dividends while reinvesting for future growth without stretching its finances too thin. So, what are you getting today for your investment? As of now, Realty Income offers a very attractive dividend yield of approximately 5.5%. In a world where savings accounts and many bonds still offer lower returns, that yield is a standout for income-focused investors. Now, you might have heard that the company had a slight earnings per share miss in its last quarter. But here's the crucial part. Despite that, the company reaffirmed its dividend sustainability. Why? because their cash flow, the lifeblood of a REIT, remains incredibly strong. This is backed by a massive diversified portfolio of properties with a sky-high occupancy rate of 98.7%. The rent checks are coming in, and that's what funds your monthly dividend. This brings us to the most important question. How safe is this dividend going forward? The outlook is overwhelmingly positive. The company has actually raised its investment guidance for 2025, signaling strong growth prospects. They're not just sitting still, they're aggressively expanding, including a strategic push into European markets to tap into new growth. Of course, no investment is without risk. A recession could impact some tenants, and there's always broader economic uncertainty. However, Realty Income's resilient business model, conservative financial management, and diversified tenant base across essential industries like grocery stores and drugstores create a strong defensive moat. Management has clearly stated its commitment to continuing its dividend growth streak.
Is Realty Income a strong candidate for an inflationary environment? We believe so. It offers a high, reliable, and monthly dividend from a company with a proven 50-year track record. Its 5.5% yield provides an income stream that can help offset the erosive effects of inflation. And with a clear growth strategy and a super safe payout ratio, the dividends look well protected for the near and medium term. For investors seeking a dependable income stock that can provide stability and growth, Realty Income Corporation deserves a very close look. As of late 2025, the overwhelming verdict from Wall Street on Realty Income is hold. That's right. Out of the analysts tracking the stock, only 3 are giving it a buy rating, while a significant majority, 11 of them, are telling investors to just hold on to their shares. Noticeably, there are almost no outright sell recommendations. On the bull side, analysts highlight what has always made Realty Income a fortress: stability. An incredibly diversified portfolio and high occupancy rates mean steady, predictable cash flow. Reliable dividend. That famous monthly dividend is seen as very safe, supported by those stable cash flows. Smart growth. They're positively viewed for their disciplined capital deployment and their expanding footprint in Europe, which opens up new growth avenues. But on the bear side, there are real concerns. Modest upside. The average price target is only around $62 to $63. With the stock trading near $59, that's a potential upside, but it's modest, maybe around 7 or 8%. That's not enough to get most analysts excited. Cost and competition. Rising operational expenses and competitive pressures in the net lease market are squeezing margins. Tenant pressure. Some analysts are cautious about potential short-term cash flow pressure from certain tenants. Realty Income is not a stock you buy if you're looking for explosive growth. The analyst consensus clearly sees it as a core holding for income and moderate, stable growth. That's our breakdown of Realty Income. Do you agree with the hold rating? Let us know in the comments below. And don't forget to subscribe for more clear, data-driven stock analysis.